Joel, is my view okay? Can you see the screen okay?
Yep, looks great. Thanks.
Okay, okay, thank you.
Test 1, 2, test 1, 2.
Good morning, and thank you for joining us, everyone. We're going to start in a couple minutes. Okay, I have 10:01, so let's get started. I want to thank you on behalf of CUBO for joining us this morning for this presentation on the Higher Education and Emergency Relief Fund and some new guidance that we've received from the Department of Education on the HEERF funding. This is the 12th webinar we've done since COVID broke out. We've tried to stay engaged with our CACUBO constituents, and we thought that these webinars would be a great way to kind of get together with you all and stay in front of you, as it's been harder to get together in person through the pandemic. As you can see the list of different webinars we've had over this time, you can see that this is the third on this HEERF topic. We had one on CARES back in May, one on CURSA in January, and now one on HEERF 3 or American Rescue Plan, or whatever you want to refer to these as. We're glad you joined us, and we got some distinguished panelists that are going to help us take us through this today. And at the end of the presentation, we're going to send a survey out to everyone to get your thoughts on what we could do better, how we could improve upon the topics, and provide some other areas that you'd like to hear from us about in the future. And if you have any interest in presenting on a topic of something that you're doing at your school, we'd love to hear from you about that as well. Just before we move on, I'll throw a plug in for a couple other CACUBO topics that are events that are coming up in the future. Next month, we have our CABO, our Accounting and Business Operations Workshop, which is a virtual webinar workshop that's May 16th to May 19th. September 27th to 29th is our annual meeting, which will be entirely virtual this year. So put that down in your calendars. And then we also have some benchmarking tools on our website that we think folks can benefit from. So please feel free to check those out. All those dates, May 16th, 19th, September 27th, 29th, are all on the CACUBO website. So you can look at there and register for those events too. And just as reference, we are recording this webinar, and we'll put the recording out available for folks to view later for those that can't make it to the presentation. And we'll also make copies of the slides available on the CACUBO website. Both the recording and the slides will be available on the CACUBO website afterwards for folks to see. This morning, I have with me, my name is Marty Mickey. I'm the Vice President of Finance at National Louis University. I'm joined by Lois Tatro, who's AVP of Financial Services at Wichita State, and Katrina Yoakum, Senior Director for Financial Analysis and Reporting at the University of Kansas. And we are supported this morning by 4 folks from accounting firms who are going to correct us when we say anything wrong. Ryan Engelstedt from Baker Tilly, Brian Simkinich from Clifton Larson Allen, Jenny Lambert from Riemann, and Ray Kraus from Sikich. So we're very thankful for everyone to join us this morning and help us out with this presentation. Just a couple words of, I guess, a disclaimer as we start. We're going to explain our understanding of the guidance that's come out. We are not going to be the ones that can support you when you provide this to your auditors. You need to work with your auditors to get their buy-in as well. We're going to tell you our opinions on these things and what we think really doesn't matter, because what does matter is your auditor's opinion on this. So we ask you that, to listen to what we have to say, but you should definitely reach out to your auditors and make sure that they agree with the approaches that you're taking on any of these topics. And just an item about questions. We've received a lot of questions and we've tried to embed them into this presentation. So I would ask you to try to refrain from asking questions in the Q&A section until the very end. Hopefully we'll cover the area or the question that you had in mind, but we will have all agreed to stay 30 minutes after the ending of this webinar to try to answer any questions that weren't addressed within the presentation. And thanks again to everyone that sends questions in advance. That really helps us and helps us to try to frame the presentation to address what you have in your mind. So with respect to the HEERF grants, just a real brief overview. This is kind of a refresher. There's two main components to the HEERF grants, the way we can spend them: the student grant share and the institutional share. The institutional share is meant to reimburse ourselves for costs associated with the coronavirus. It has to be a direct connection to the virus in some way. And those costs include lost revenue, technology costs, faculty and staff trainings, and some incremental payroll. And you can also use that institutional share to make additional financial aid grants to students on top of the student grant share, which we're going to talk about. And obviously the reason we're here today is we just received some new guidance from the Department of Education with respect to student grants and lost revenue, and that's really what we're going to talk about today. With respect to the new guidance, we've kind of chunked out the different guidance into three areas. First, student awards and spending periods. I'm going to talk about that with the support of Ray. Kind of talk about the new eligibility, folks that are eligible from a student standpoint, methods of distribution, what periods you can claim the funds over. And then we'll shift over to lost revenue, and Lois will talk about that with the support of Ryan and Jenny. And then finally, we'll talk about some other questions, other areas that haven't been addressed. The areas that we still have lingering questions about, I guess you might say. And Katrina and Brian will kind of talk to that when we get to that point. So first, with respect to student grant eligibility, the big change here was that with respect to providing these grants to students, you now can provide grants to students that are not Title IV eligible, including non-degree seeking, non-credit, dual enrollment, and continuing education students. You can continue to provide the grants as you have in the past with respect to using block methods, block grant, where you just give a broad population of students the same amount, or you can have an application method, which is what we do at our school, where we have students apply and indicate what their need is and how they've been affected by the pandemic. But the students that receive the aid have to show some form of exceptional need. You have to have a way that you're distinguishing these students, that you're giving the money to those with exceptional need. And you'll have to be able to demonstrate that and document that when you're done. You can also provide these student grants now to students who have left school for any reason during the COVID period. I have not heard of any schools that are doing that. At our school, we continue to just be providing the awards to students who are currently enrolled with us. But there is this new provision where you can provide the money to students who have left school for any reason. And you can also eligible now are students who are qualified aliens, including refugees and persons granted asylum. However, we do not believe that DACA students or international students are eligible, still not eligible. We can now pay, and I think we've been doing this, pay student grants through the normal way that we pay credit balances, refunds to students, through the checks or debit cards that we have on file for them. We can pay the student grants in that way. And once you draw down the funds from the government, you must provide those grants to students within 15 days. And also with respect to the student grants, I didn't talk about it here, but the same provisions that with respect to HEERF 2 that were in place, where you can apply money to a student with respect to applying it against their tuition if they give you the consent to do so, that still exists. So, like on our application, we have a question for students if they have one of their reasons for need is tuition assistance. And if they check that, we ask them their consent to allow us to provide that offset against their tuition. And if they give us that consent, we do apply that grant, if you will, against their tuition, and you can continue to do that. With respect to the time period over which expenses can be claimed, this is kind of a big thing in that we can now go back and claim expenses using the new rules back to March 13th of 2020, both institutional and student grants. We can go back to that point in time and capture expenses that now meet the new criteria and go back and charge to that point. And the period over which we can spend the money is generally has been 1 year after the granting of the award. But the new provision here is that the expiration date for any unspent HEERF 1 or HEERF 2 funds is now amended to be the same as what that 1 year anniversary will be for HEERF 3. Now, we've not received our grant notification, our GAN letter yet. I don't think anyone has. So we don't know what that 1 year period, 1 year anniversary period will be. But when we get our GAN, we'll know that, and the HEERF 1 and HEERF 2 funds that are unspent will have that same expiration date, if that makes sense. Ray, I'm going to turn it over to you to see if you might have anything to add on that or the previous slide.
Yeah, sure. One thing that's important too is really identifying, as mentioned, it's really for the neediest students, and really the easiest way to identify them would be requiring the FAFSA. Having a FAFSA is going to really accomplish a couple things. One, it's going to identify need. And second of all, it's also going to cover the citizenship question. Remember, with respect to needing to be a citizen, to be able to receive funds. So that FAFSA is important. The other thing it will allow you to do too is, as Marty mentioned, you could use a block method by giving students the same amount. But with the FAFSA, since they can identify need, then you decide if you wanted to use a tiered approach. In other words, over certain amounts of need, a student receives X amount. If they have additional need, they would receive a different amount as well. So that FAFSA is really key because it does accomplish a couple things with respect to identifying need and also the citizenship.
And then down at the bottom, we had a question that came in. You know, we believe that there's going to be extensions after that 1 year period expires, but we do not know how we are to apply for and receive that extension. So I think that's still a question, but I have heard, or we've seen some guidance that there will be extension periods allowed.
Yeah. And looking right at the actual American Rescue Plan, it does say on the Higher Education Section 203 that funds will be available through September 2023. So that would imply that you would have up to that time to receive and spend those funds.
Great, thank you. So that's even later than the 1 year after the notification, I guess. So I should correct myself there. So we have until September of 23. Thank you, Ray. So then finally, this other section I want to cover before turning over to Lois was a new provision with the guidance that I think is very helpful. It's been helpful for us at our institution, is being able to utilize the institutional share to discharge unpaid student account balances. So we can use our institutional share, not our student share, to go back and discharge open balances with students to allow them, to help them to persist and continue with their studies. So we've had some students that have stopped out and have not been able to continue because they have past due balances and we have a hold on their account and won't allow them to continue until that hold's cleared up. We've been able to reach out to those students and work with them and forgive those past due balances to allow them to persist or continue into our spring quarter. We're in a quarter system. So that's been huge for us to kind of improve our continuing numbers for the spring quarter. However, I will add that this is really a slippery slope. And I've heard a lot of institutions talking about not wanting to go down this rabbit hole because it kind of rewards students who haven't paid in the past, kind of rewards bad behavior. So this is something we've done. I mean, the fear is that the students will say, "Oh, I'm not going to pay because they're going to forgive me that balance later." But you know, this is one provision that's helpful. And there's also a provision that we've not been utilizing yet. The new guidance allows you to reimburse expenses to subsidize the child care services for student parents. That's another provision in the guidance that we've not gleaned onto, but it is out there as well. So Ray, I don't know if you want to talk about the couple things at the bottom.
Yeah, real quick on also the institutional portion too. Remember, the students have the ability to use their student grants to satisfy their balances too, but that requires permission, whereas the institutional share, you could just apply that to. So schools can really decide, you know, if they're not going to be able to spend all their institutional money and they have that leftover money, they can go back, as Marty mentioned, and use it to discharge old outstanding balances. A couple things at the bottom is mentioned. The 1098 guidance was something that has been out there, and is a lot of confusion on that as well, because in 2020, schools weren't required to include the CARES money in their 1098 disclosure, and the same is going to be true for 21. Although in box 1, of course, the students could include part of that CARES money or that HEERF money that came in. In box 5, you're not required to specifically identify it. So even though it might be in total in box 1 for the total payments received, that that CARES or HEERF money could be part of that. The schools aren't required to separately identify that. So that's a relief to schools. I know that was going to be a very complicated thing to really understand how much each student used for their particular case.
Great, thank you. So we're going to shift gears now and turn it over to Lois to talk about lost revenue.
Thanks, Marty. Actually, first, I'm going to ask a question from your previous slide. Just a clarification question that came up in my mind as you were talking. On that very first bullet about using the institutional share to discharge unpaid student account balances, do you feel, or you or Ray feel, that you can use that for international student balances then, since it is the institutional share?
That's a good question. We have not been doing that.
Okay.
But it is a good question.
Yeah, I would think it would still fall under the same category as the student portion, because back to the Act of 1996, that still prohibits the use of federal funds for that method. So I would think it would still fall under the same guidelines.
Okay, thank you.
And I'll just add on this thing. I've heard of an institution who has folks that they're holding up the transcript for until they pay their past due balances. They're using that to forgive those balances so they can provide that student the transcript. And what that does is it relieves your bad debt expense a bit. I mean, it takes that those monies that you never thought you'd get and pays for it, I guess you might say. So I don't know. I think that's kind of a slippery slope too, but I think that's another way that you can utilize this provision.
Okay. All right, thanks. And I think that's just further proof that even though many of us are completely immersed in the HEERF world every single day now, the questions just never stop. I mean, it's, it feels like every time we read new guidance or we ask more, there just are more questions. And which is really why I appreciate this type of forum where we have this ability to get some information from our colleagues as well as from our business partners at CACUBO. All right, so I'm going to move on now to lost revenue and just start with kind of the definition that we have received from the Department of Education, which was greatly appreciated. That lost revenue is the amount that a college was expecting but was eliminated or reduced as a result of the pandemic. And because of that, I mean, it just assumes in the fact that lost revenue can really only be an estimate. But what types of lost revenue could you take? Well, obviously tuition and fees, other institutional charges on the academic side. As I kind of looked through that list and thought about our institution, the one that was more of a surprise to me and one that we hadn't really considered is the reimbursement of lost revenue for our summer camps. I don't know, many of you may be in the same boat, but we in the summer house a lot of high school and college students coming in for different types of camps and other activities. And last summer, we certainly had none of those on our campus. And so I know we're going to have some lost revenue available there that we will certainly be looking at. And then on the auxiliary side of your university, you can look at disruption of food service. Like we've talked a lot about dormitories and our housing cost. Childcare is another area I think that was specifically added that is good. Many of us have childcare services provided by our campus. The use of facilities or venues, again, this one triggered some discussion at my institution. We have a museum on campus. It does not qualify for the shuttered venue relief that has been provided, but there definitely are lost revenues there. And since they are part of our institution, we will be considering taking that as well, or looking at that as a potential use of our HEERF funds. The very last item on this list under auxiliary is really the other operating income. And, we feel like that was an intentional add by the Department of Education to say that you have some discretion here, and that to look for the areas where you really have lost revenue that might not be specifically excluded in their guidance. So then let's talk about what we cannot take. And again, DOE was very gracious to tell us exactly what we cannot take. And that they continue to stay on the wavelength that athletics and supportive athletics is really not allowed, especially as it's related to facilities or capital outlays. You should not reimburse from your HEERF money any acquisition cost of real property, contributions or donations, whether they were to your institution or the foundation. Marketing and recruiting activities, I've again internally received a lot of pushback on this, and wanting to really use some HEERF money for lost revenue or additional expenses actually in those areas. But they are specifically excluded, so our guidance would be to tread lightly there or stay away from it. Any revenue related to sectarian instruction, religious worship, alcohol sales, investment income, some of these other items seem fairly clear-cut and items that we probably would not try to claim. It is interesting in that athletic income was not specifically excluded, and therefore this is a great example of the other income that was clearly added as allowable. So we will be looking at our ticket sale loss from last year and try to make a decision on if that is a good use of our HEERF money. I think the key here, though, is to really remember that to claim lost revenue, it must be attributable to the coronavirus, and it can't be due to any other cause than the pandemic. And also just remember not to double dip. Again, at our institution, we have refunded our room and board expenditures back to the university using our HEERF money from HEERF 1. So we will now need to use that revenue and claim it against or include it in any calculation that we have of lost revenue going forward in our housing area for that term. Okay. Okay, so we'll go then talk a little bit about when do you claim this lost revenue? So a charge to the HEERF for lost revenue should be claimed at the end of the period that you're using for that calculation of lost revenue. So if in a particular instance of lost revenue, you're looking at a fiscal year calculation, then you're going to recognize it at the end of the fiscal year. If you're looking at a term-based, term meaning fall, spring, summer, or I know some people have terms that are 8 weeks or 4 weeks in length, you could recognize it at the end of that term that's used in the calculation. And just be sure to avoid booking lost revenue in a different year, as it could smooth the earnings. On the CEFA reporting, again, the basic premise around CEFA would be to report expenditures in the year that the expenditure was associated to that federal grant. So some of us would have reported some CEFA, some of this HEERF money or CRF money that we received or we expended in fiscal year 20. But the monies that we're talking about now, that even though if it was received in 20, we're expending it in 21, we're going to report that as part of our fiscal year 21 CEFA report. And also keep in mind that several years may be in play. I mean, we know HEERF 3 guidance is coming. None of us, I don't think anyway, have received the actual award yet, but you could be looking at multiple years in the timing of this expenditure reporting.
And Lois, if I could maybe just
Absolutely.
on the disclosures too, because we're going to have some expenditures or lost revenue that we're recouping because we can go back to the prior year, we're going to see some overlap, if you will, on the CEFA. And what we're going to have to probably do is have additional note disclosures to talk about the different periods that we're covering in the fiscal 21 CEFA.
Good point. Yes, thank you, Jenny. And then finally on this topic, just to be cognizant of the rules that require spending of the student share before the institutional revenue share of the revenue can be recognized.
On that, Lois, did you want to talk? I think that's the interesting part about HEERF too, is that on the institutional share, where it's so much more than the student share, I've been hearing that you can recognize a pro rata share of your institutional share in the same relationship to what your student share has been recognized as the percent of total that you have for HEERF 2. I think that's kind of interesting to. So if you've spent 1/3 of your student share, you can recognize 1/3 of your institutional share. That, you know, the HEERF 2 was so different, and the institutional share was a different amount than the student
Right.
share, whereas CARES and American Rescue Plan, the two are the same. I'll just add that. Sorry to interrupt.
No, that's a great point. It's one, again, that at our institution, we have completely dispersed all of our HEERF 2 student aid. We had students in need, and so we decided to do a block grant and disperse it. So it is an area that I haven't focused on as much, and really appreciate everyone else assisting in that question. And then the last item on this slide would be just the guidance that we've received that said there's not a need to assign a specific cost against the lost revenue estimate. So from a purely accounting concept, you'll book that revenue as it comes in against your HEERF federal fund, and then you can either use a non-expenditure account code or a transfer out from the HEERF fund, and a non-revenue, or a transfer into your receiving institutional fund. At least that's our thoughts on it. And again, Jenny or Ryan, if you have any additional words of wisdom on that, definitely interested in hearing it. Okay. So again, the guidance provided by the Department of Education has provided a lot of latitude to institutions to select the method that you want to use to calculate lost revenue. And we're going to go over some very specific examples here in just a minute. But in summary, they've talked specifically about a year-over-year comparison using the prior year. If you do select that one and your fiscal year end is on June 30th, then you may not be able to draw down or really collect any of that money until after that year is closed on your books. So that is one item to keep in mind if you do a year-over-year comparison. Again, you can look at semester over semester using the prior year, fall of 2019 versus 2020, summer to summer. Again, the 8-week terms would fall in that same category. They did allow for a comparison of previously budgeted revenue or even projected revenue for a given period, which I thought was an interesting add in the guidance, and definitely something that's going to give flexibility to some institutions in that area. You can also do a comparison with a baseline year. So you could pick a fiscal year, such as fiscal year 19, and use that as your comparison period for fiscal year 20 or fiscal 21. And last, comparison of a 3-year or a 5-year average period is allowable. Again, at my institution, I don't think we'll be doing either a 3 or a 5-year average, but definitely probably considering a baseline year of 2019. We're really just taking a look at all of the different calculation options that have been made available to us, and are going to review those thoroughly, both internally and with our auditors, to ensure that we're choosing the right method for this calculation. And last, it does also allow for siloing, where you can select the revenue from a particular program and take the lost revenue just from that program, as opposed to the revenue from everything within that category. So again, a particular academic program may have lost revenue, but another academic program didn't. That seems to be allowable in this lost revenue calculation.
I will add, Lois, I've
Yes.
gotten guidance that I should just look at like we're a university with several colleges, and I'm looking at the college, and
Okay.
and to go much lower, I've heard that that's a little slippery, but it's gray. So
It is gray, right? And I think that just leads right into the last point, is to be consistent, but also to document everything that you're going to do, what your rationale was for your decision, capture that underlying data, save it, keep it for the 3 to 5 years that you're going to need. Document the calculation method that you used and the rationale. Again, the rationale, why you chose that method. I think if you're consistent and there's logic, that's going to go a long way towards supporting your claim. And with that, I'm going to turn it over to Jenny to talk about some of the questions that we've received from all of you.
Thank you, Lois. Yeah, as Marty mentioned, we had received questions ahead of the webinar that we're going to address here, and I realized there's questions already popping into the Q&A, which at the end of the presentation, we'll get through those in more detail. But to go over the ones that we've already received, one was, can an institution use a 5-year average to determine lost revenue for rentals? and use a year-over-year calculation to determine lost tuition. And we actually got this question a couple of times over in different scenarios, but yes, you can use different methodologies for different revenue streams. You don't have to pick one methodology and apply it to every single revenue stream. What's key is what Lois pointed out, is to be consistent. So if you're going to use year over year for lost tuition, then you need to be consistent with applying that methodology for tuition and so forth. But you can use different methodologies. Make sure you document the rationale and ensure that it's reasonable. Another question we got: if HEERF funds are used as lost revenue, how do we record on our financials? Is there a uniform guidance reference to support how the entry is recorded? First of all, no, there is not a uniform guidance to reference how the entry is recorded. If you recall, for HEERF 1, we recorded those HEERF funds as one line item on the financials as higher education emergency relief fund grant revenue. We didn't break out student portion and institutional portion, it was all together. And that's how it'll be done as well for fiscal 21. I can speak to governmental colleges in that we reported that as one line item under non-operating. Ryan, I know, works with private, so he might be able to expand on how they do it. But one thing to note is you'll still have to track the components of the HEERF grant revenue, with student portion, and then break down the institutional portion for your lost revenue components, your payroll, what you give out in student grants through the institutional piece. One, you need it for your quarterly reporting, but you also need it for the single audit so that those components can be tested for compliance.
Yeah, Jenny, if I could just chime in here real quick, I'll elaborate a little bit as to the presentation as it pertains to private institutions related to the HEERF funding. So it seemed the typical practice in for the FY20 financial statements, and I think this is the case, whether or not the institution was showing an operating measure or not, that the normal government grants revenue line within the operating revenue section of the statement is where the HEERF funding, both the student and institutional portion, was reflected. And then to accompany that, given the substantial year-over-year increase that it caused, and just the significance to the financial statements, reports we were involved with typically would have a footnote disclosure or expanded disclosure within the government grants note that talked more specifics about the HEERF funding and how it was out, how it was used, and the portion and the amount of the portions for each on the student and institutional sides.
Thanks, Ryan.
Yep. Thanks.
Yeah, the next question is a unique one. Can we use institutional grant to reimburse membership fee loss for newly built health and wellness center, which was scheduled to open in fiscal 21, but didn't open and put in the budget yet? So I'm assuming a couple of things. One, I'm assuming that the reason it didn't open was COVID related, and that this is not relating to the construction of the center, but for operational cost, because you would have membership fees brought in to help cover your payroll, utilities, and so forth. I would think you'd be able to use some of the membership fees to recoup some of them for the costs that you are incurring. I think you need to look at what the expense side of it is with the utilities and maintenance, and what you would cover with membership fees. Hopefully there was a projection done up front. It appears the number of members we're expecting and the membership fees, and then from there look at, again, how much of that would be used to cover your current operating costs to figure out the right dollar amount that's truly the net loss revenue. And hurry up and put it in your budget so that is covered. Here's another unique one FAQs don't cover. If your bookstore and or athletic areas are separate legal entities but are affiliated corporations, can the university use their HEERF allocation to cover lost revenue at these entities for bookstore sales, athletic ticket sales, etc.? As I said, it's not really addressed anywhere, but I would think that since your application was for your specific entity and you provide your OPE ID number and you're a separate legal entity, that from a conservative standpoint, you would not be able to apply that to other separate legal entities. But there's always caveats on how they're affiliated, or if they're like a wholly owned subsidiary that's consolidated, or if there's a certain relationship. And would recommend talking to your legal department on those relationships to make a better determination.
All right, thank you. I will take us through the next couple slides here that provide some examples of approaches that could be taken. Again, there isn't a true directive here. The guidance is quite flexible. So the content that is on this slide actually comes right from the FAQ document that the department has issued. It's the final page of that document. So I'll spend just a couple of minutes talking through these different scenarios here and what this what this could look like. Internal alignment. But again, keep in mind there's flexibility, and the idea behind all this is choose an approach that provides for a result that is the best depiction of again, getting back to the definition of lost revenue, the amount that was anticipated to be received. However, due to impacts of COVID, was either reduced or eliminated. So that's the key in determining what the right approach would be. So example A here, fairly straightforward, looking at the entire FY21 collectively. And as Lois mentioned on a previous slide there, as far as the approaches that were noted within the FAQ, certainly a 3-year average could be utilized. So here, and of course, you'd want to look at for the 3 years prior to the year that included COVID impacts setting in. So here, FY 17, 18, and 19. For simplicity of numbers here, we can do the math, but you can see it averages out to 100 per year. And then fast forwarding to the actual results to FY21, the actual revenue received by the institution was 50. Therefore, easy math gets you at a lost revenue of 50 in that particular scenario. So the amount is charged, and as noted earlier too, it's on the last day of the period that's being utilized. So here, the anticipation would be on June 30 would be when the charge for that lost revenue would be reflected, and therefore, as noted, also picked up in the FY21 CFA in that scenario, of course. The next example here, example B, is meant to capture the impacts that came from that the onset and what transpired during that last few months of FY20. And in this case, the example uses a year-over-year comparison, and based on that, it in essence necessitates the need to look at a pro rata portion based on the number of days impacted during from that pandemic period. So there's in the calculation section there some math that's involved to get to what they're showing for this particular example to be a potential result for lost revenue. Now, I will say that this approach here, and we've received a number of questions from clients on this, and it certainly gets a bit tricky because, of course, the most substantial piece of lost revenue during that last few months of FY20 was primarily tied to room and board. For the majority of institutions, I think many found that they were able to quickly transition to distance learning, and students continued on. So the tuition revenue, for the most part, stayed intact. But on the room and board revenue side, of course, then you've got the impact of the concerns around double dipping based on what was obtained in that first round of HEERF. So in many cases, I think institutions will go back and maybe perhaps take a slightly different approach to come up with what the appropriate number is that remains for that last part of FY20. Based on the extent of their room and board refunds that weren't captured on that first round of funding, And then anything else, any other revenue streams, certainly there could be some other revenue streams where it does make sense to apply, some kind of pro rata, calculation to it. So it's certainly a case by case situation there. Again, here, as noted earlier, even though this ties to FY20 activity, if you will, given the guidance and the additional funding was not provided until into FY21. The idea there is that there certainly be no need to go back and revise anything related to your FY20 reports, your CFA, et cetera, financial statements. The amount that's being claimed would get captured within that FY21 CFA. So moving on to the last example here is looking specifically at the fall term for 2020, so FY21. And here's where, and I think, certainly taking an approach of what was budgeted for students is probably a very common one that we will see across the industry. Certainly some, prior to COVID setting in, budgets were in the works and based on anticipated new student enrollment, et cetera, and typical retention rates, some figures developed as to what was expected. Certainly, I'd say if this approach is taken, you'd want to be able to prove that the institution has had a good track record of being able to achieve actual results that are similar to what they had budgeted. But presuming that is the case, here, this example provides for, again, $100 on the budgeted side, $40 in actual, so you've got a $60 residual that would get picked up as that piece of lost revenue. So again, there, as you'd expect, given the timing of it, that would get charged to the grant. If you're looking at that specific term, you'd charge it at the end, so perhaps December 30th. And then again, they're captured in the FY21 CFA. Okay. So here's an example on the siloing, and I know there was a question that came in regards to the acceptability of this type of approach. And as mentioned, there are various approaches called out within the FAQ, but I think the intent is, perhaps that it's not intended to be all inclusive. And if there's other approaches that again get you back to being able to best portray or depict what the impact was for your institution, there perhaps could be scenarios where you would look to this type of approach, especially if there's characteristics of the different colleges within the university that, based on the nature of the programs, were more likely to be impacted by students, in this case, new students deciding to come on board, or perhaps taking that gap year that we heard many talking about. So I think there's certainly considerations to be had here, and obviously all gets incorporated into the rationale that's documented. So this example here, again, looking at those new students that were anticipated for the fall term, you can see here for two of the colleges, there was a result that was less than budget. So from there, taking that difference and applying it against average student revenue, and the belief is that this would be the net tuition and fee revenue that would be received by the institution per student, as that obviously correlates to the amount of actual cash inflow resources that were anticipated from those students' attendance. And then from there, that leads to the fall quarter estimate, and then certainly projecting out for the rest of FY21, looking at those normal attrition rates that the institution has experienced, and building that into the plan as far as the use of the fund. So some expectation that get to the end of that period and look back to see that those attrition rates and such are still appropriate. At the bottom there, it does incorporate some additional revenue streams that are looked at. So certainly conferences, workshops were significantly impacted. So they're not surprising to see some large numbers coming through based on what was anticipated, built into the budget for those types of activities, getting to that overall total of $2.8 million there in this particular real life example. So with that, I guess I'll pause maybe in case Lois or Jenny have any additional comments or anybody else in the group. Otherwise, move on to the next segment.
Okay, so moving on to indirect costs. I know for, at least within the University of Kansas, that their indirect costs, or also known as facilities and administrative overhead, has gotten a lot more discussion that are within our internal, that are discussions of how we're going to plan on spending our HEERF $2. I think given that HEERF 3 has now come out, and I know originally when HEERF 1 came out, we had so many direct expenses that, you know, there was no need for us to even consider that they're drawing down an indirect. But now with the addition of HEERF 2 and HEERF 3, I think this discussion has definitely had more discussions internally. For what we know, that their indirect, that their administrative cost allowance is allowed, that they're on all 3 HEERF awards. There were 2 options, that there schools that don't already have, that their previously approved rates that have been negotiated with your cognizant federal agency, that there can use a de minimis 10% rate based upon modified total direct costs, or that there, if you're like KU, that there, we actually have, that there are multiple rates that we have negotiated previously. For us, that's where we have determined that if we're going to apply the indirect, that's where we plan to use our other sponsored activity. We've decided that probably is the more appropriate, that's a rate versus our instruction or our sponsored research rates. As I mentioned, that there can be applied against all 3 awards, but we do still have to follow all uniform guidance that's there, and that applies to both direct costs as well as indirects. And that's there, as specifically mentioned in the guidance, that there, it cannot be taken against student awards. The expectation is student awards, that money, everything goes to our students. That there, I will mention just some things to be definitely considered. If you are a school that does not, that has not really dealt with indirects before, I would highly recommend that you have a conversation with your auditors before you claim any indirects. There are a lot that there, as I mentioned, within uniform guidance, there are specific rules that there as to which expenses that their indirects are allowed on, and there are expenses that they are not allowed on. Specifically construction, that you cannot claim an indirect on construction. And again, if you're a school similar to KU, I would recommend that you have a conversation as to which indirect rate would be the most appropriate. Also, something to take into consideration is when you want to take the IDC versus the administrative costs, and especially when we're considering lost revenue, as with everything, we need to be aware that we don't accidentally double dip, and obtain a benefit on both items. So I know that's a conversation we're going to be having internally, that there is, when what we need to do to ensure that we can prove that from a documentation perspective that we're not double dipping. One specific area that we are looking at, that there is, while we may have a negotiated rate that are of a certain percentage that are on our sponsored awards, we don't always receive that full administrative, that's our reimbursement. And so that is one of the areas that we're going to be taking a look at to be able to document that while we may be claiming the indirect, that's are maybe on lost tuition, we can document internally that we weren't, we didn't receive the benefit or the reimbursement of those indirect costs that are through some other means, because we don't receive the full indirect on some of our other sponsored projects. Brian, do you want to jump in on some of the things that you're seeing from other schools that you're talking to?
No, I appreciate that, Katrina. So I just wanted to emphasize, and you kind of summarize exactly what I was going to say. A lot of institutions that are received the HEERF money potentially never received anything other than federal student aid in the past. So, it's kind of unknown to them how to administer any additional federal aid. So when you are receiving this, we've been asked the question several times about indirect administrative costs. Just make sure you're reaching out and talking to your CPA or your external accountants on that if you're not comfortable with these, because the calculation is not necessarily as simple as you may think it is. So just make sure you do reach out and talk to them on that topic. The one thing that we do have as it relates to the department's considerations on this, was the for-profit proprietary audit guide that was released a couple of weeks ago. It did hint at what they want potentially to be looking at as it relates to indirect cost. And specifically, like Katrina mentioned on double dipping, they were focusing on the base, what expenses are included in the base allocation, so your modified total direct cost or the costs that are included within your cognizant agency rate, making sure that whatever costs that you're incurring as the numerator are appropriate and consistent with the base. So when you are applying this, just know that that's something that the department has at least already acknowledged that they're going to be looking at in that audit guide, but we don't know how it's going to translate potentially to the compliance supplement. But that is one thing we did want to mention as it relates to the indirect cost as of right now. All right. And moving forward, we did want to just highlight again procurement reminders, and this kind of does go back to what I just mentioned, that a lot of the HEERF awards from the CARES Act, specifically on the institutional side, were used for lost revenue from refunds that were issued for admissions or for auxiliary operations. So in that respect, you didn't have to really consider procurement requirements. But if you're an institution that really doesn't have any federal aid outside of student financial aid, and you're going to be using these federal monies for direct costs to vendors or any other third party, you do have to consider procurement the procurement policies. And you need to ensure that your institutional policy is at least as strict as the federal procurement policy. There are requirements that you need to consider. We obviously mentioned here a few of them. The conflicts of interest, you need to evaluate from your vendors to make sure they're not debarred or suspended. And you also need to make sure that they're adhering to the Daniel Bankin requirements for payroll requirements. So you need to do due diligence on your vendors before you actually engage one of them to perform an allowable cost using the HEERF money. You obviously need to make sure you have documentation of you're addressing the cost and price analysis. This specifically goes to bids and considerations that you have for your larger projects. So for anything under 10,000 is a micro threshold. You don't need to have any competitive bids, but you do need to have adequate documentation to support that cost. Anything above 10,000 to 250, generally, I will say there's always caveats to this, but generally anything over that, you do need to have a bid process. And it's because it's considered a small purchase. And then anything over 250,000 does require a competitive or sealed bid. Now, we do say that, and then there's also caveats as mentioned below that, in the event of a public emergency or there's only a single sourced vendor for this project, there are exceptions to this policy, but you do need to document that accordingly and make sure that it's reasonable and appropriate for, your upcoming audit. The one big example that we saw here was testing, and a lot of institutions are going back and applying federal HEERF money for the testing expenses that they had back in the summer and the fall, and they did sole source those because at that time there was very limited resources available for providing those testing services. So what we're recommending is if you did do that, or if you had any other significant large purchase that occurred prior to today, make sure you go back and review that documentation to make sure that everything adheres to what the procurement requirements have. And if there's any questions, because you're not comfortable with this or your institution maybe has not had to deal with federal procurement requirements in the past, just reach out to your auditors or your CPA to walk through this process to help you get through and get ready for your upcoming audit. Katrina, is there anything else you would want to add to that slide?
Nope, not at this time.
Perfect.
So I think at this point, we're just going to go into the variety of different questions that came in that's ahead of time.
Absolutely. So I'll take on the first one as it relates to using the institutional grant to reimburse for utility costs for underutilized campus. What we're saying for that one is generally that cost would be not allowable, because in essence, your lost revenue that you could be generating for the underutilization of that revenue stream would cover the expenses associated with that revenue stream per se. There is a requirement in each of the GANs or each of the supplemental agreements that institutions have that to the greatest extent possible, they're supposed to continue paying employees and vendors. And in that instance, the lost revenue that you would be generating from this revenue stream would in essence cover the underutilization for this operation. Now, the one exception here is if you had to get additional facilities or you had to get additional utilities for some odd reason related to COVID, those additional costs that you would not have occurred during normal operations would be allowable under the grant, and you could charge it towards the HEERF grant. think Katrina, I'll give the next one over to you.
Yep. I'm going to be on the second one. For payroll, I think the biggest thing that's through with this is kind of, as we've mentioned in other areas, is just to be aware of double dipping. That's when it comes to payroll, again, as Brian mentioned, the expectation was that we would continue to pay our employees and our vendors. But obviously there were, I know for KU, we had individuals that we hired specifically because of COVID related. We added a call center so those are at least for us, we took a very conservative approach when it came to what payroll we ran through our federal funding, and really tried to kind of keep it to where it was individuals that were dedicated and were new, or they were in a brand new position, their old position may have been let go, they were put into a new position. I think the other thing related to this is for when we have administrative leave, obviously really goes back to what your policy was beforehand. So if paid administrative leave was not normally allowed, but based upon federal guidelines, we now had to pay those individuals because it was a federal requirement where we had the 2/3, 1/3. Those we did claim as an eligible COVID expense because that had the nexus to COVID, and without COVID, we wouldn't have been paying those individuals for not working. And again, from an IDC, you would need to take that piece out. And
So we got the
then
next,
on the piano repair.
yeah.
Yes. So on the next one, go ahead, Brian.
Oh, I was gonna, sorry. Go ahead, Katrina. You can take this one because we just got this one last minute.
Okay. Yes, so on the pianos, I think again, if it has a definite nexus to COVID, that you would not be replacing those pianos, or they would not have been damaged. If you were not providing those sanitizing wipes to clean the pianos, and that's the only reason why they were damaged. I do think you could claim it as a COVID-19 expense.
And the only thing I'll add to that one, Katrina, and this kind of goes with any equipment, if there was any consideration on upgrades during the period that were budgeted as part of the normal operation for this year, if by consideration that item was going to be budgeted to upgrade, there's a consideration that was not due to COVID. You need to look at that as when it looks to equipment. So if this piano was going to be upgraded this year, there's a consideration that needs to be taken. Should it or should it not be allowable from that reason? So if there's clearly no plan to upgrade any equipment, then and it's COVID related, you're good. But if there was a plan, you need to consider that, and that was specifically discussed by the Department of Education. All right, so we've gotten a question already on this one related to payroll, specifically for employees who were existing at the institution, continued with the institution, but had a change of work responsibilities specifically related to COVID. And from our understanding, and specifically, there was an FAQ in the previous CARES Act guidance that discussed this, that if you're continuing a normal pay as you would expect the employee to receive without COVID, an employee would not be eligible or the institution would not be eligible to apply the funding for the proportion of that individual's job related to COVID. Now, if you had to pay that employee additional amounts, or if you had to hire additional employees to cover any COVID related items, that would be allowable. But just the consistent payroll that an employee would have received would not be allowable, even if they did have a change of role or responsibility within the institution. I think, Katrina, you want to layer on a little bit of your...
Yeah, that's right. So just continuing on with the payroll perspective. Again, I think that some of this is you need to be having conversations with your auditors, as to how conservative you want to be, versus taking a little bit more. I know for KU's perspective, as I mentioned before, we have taken a really conservative approach. And part of that is, one, I did not want to take a chance of time and effort reporting, which currently has not been stated. But that does not mean that the Department of Education cannot come down at a later point in time and say that we have to do time and effort. And I did not want to take a chance of not having systems in place at the time that we were paying individuals. So at least for KU, one of the things that we have done is we have pretty much restricted our payroll expenses to individuals that are 100% dedicated to, that's a COVID position that was created because of COVID. As I mentioned before, we have a brand new call center on our campus. That's where we also hired, that's our temporary nurses, that's our to assist, that's our with our student health system that was being overrun, that's our with testing and with questions coming in. That there, I will directly mention on the question of time for employees to install technology improvements. We did, for any internal labor that was used to install the technical equipment in our classrooms, we did not charge any of that. That's to our federal programs, because that was an individual that was previously budgeted out of our central funds. However, because of timelines, where we were trying to hit specific deadlines, we did hire third-party providers to complete the installation. We did claim the third-party providers as an expense, because we would not have paid them or we would not have hired them if we were not trying to hit a deadline of trying to get our classrooms ready for the fall as quickly as possible. So again, I think part of this, you kind of have to determine how conservative you want to be. But just take into consideration, does it really truly have a COVID connection? And can you truly dedicate, and can you connect the payroll to it? Brian, I think the next one is yours.
Yep, and we'll get through these ones pretty quickly, because I know Mickey or Marty, we have questions and answers for the next 30 minutes. But this one right here, as it relates to claims and investment, can you claim incentives for employees? This one's a gray area, because generally marketing and advertising expenses would not be allowable to be reimbursed, or any swag, as we would say, for that, if it has advertising for the institution. So if you're advertising the institution in relation to this incentive, that needs to be evaluated. If you're just giving, if it doesn't have any marketing or advertising to the school, it could be considered. There's a couple of provisions within the federal regulations that could allow this, but I would say work with your auditor. And as well, look and see how much this is. This may not be worth the time and effort to evaluate, but if it's something that's important to the institution, I would recommend discussing with the auditor, because it's a little bit gray, unfortunately. And then HVAC projects, I have looked at this specifically, and related to procurement, there is pre-approval requirements for certain federal spends. If an institution spends money for a certain item, there were certain pre-approval requirements waived. One of them is equipment, but the one that they didn't waive were certain capital improvements. And what we have determined as it relates to HVAC is it's obviously something that potentially increases the value of an asset, which is your building related to it. And that was not falling into one of the prior approval waived categories. So you would need to reach out to the Department of Education to get approval for this expense. But I know that I have one institution that already did receive approval for it based on their proposal and plan for it. So, but you would need to get that prior approval for this expense. And then obviously you would need to leverage it, that it has nexus to the pandemic, and it was not something that was previously budgeted to be done prior to the pandemic. Katrina, you want to hit really quickly on the last one?
Yeah, that's right. So in regards to the rebate on the procurement cards, honestly, I don't think it's going to be significantly material, but as an institution that receives rebates on our procurement cards, that also has sponsored research, some of those purchases were related to sponsored research projects. What we have done to recognize that rebate is within our indirect calculations. We actually count that rebate as a reduction of our administrative expenses when we are doing our indirect cost rate calculations going forward.
And then the last one on this slide related to the 90 days, that is still applicable for the HEERF2 awards, that for both the institutional and the student portion, you do need to draw it down to, in essence, accept it if you had previously received the CARES Act money. So for a lot of our schools, that time is coming up. One thing I will point out for that there's been some schools that have had concern because the CARES Act money and the CRISA money were commingled after the beginning of this year, so there were draws from both. We've recommended that if you're concerned from that perspective, you can reach out to the Box 2 representative for the Department of Education and just email them and let them know that, hey, this institution is drawing down funds related to CRISA on this date, for institutional and student portion. Thus, we're accepting our award. It's not required. There's no guidance for that, but it puts some documentational trail in that the institution has that they're accepting that award. And I did have one institution receive an acknowledgement back from the Department of Education that they acknowledged that receipt. Now, we haven't seen any institution have any repercussion for not drawing it down, but we wouldn't want any institution to have a negative impact due to that one little clause in the supplemental agreements. And then the last one, HEERF 3, we just wanted to cover that as it relates to guidance, unfortunately, the Department of Education still has not provided anything additional yet. The only thing we know is what came from the law at this point. And what we know at this point is it's going to be a 50-50 match. So the institutional portion and the student portion will have to be spent evenly. They did extract the 30, 60, and 120-day requirement that the DOE had to get the money out, like they had in the Carissa Act. So that bought them some time potentially to get it out. But we just don't know when the language, when the regulations, or when the money is going to be available. There's no excise tax for this award based on the regulations. And then there is a clause in there that institutions will need to use a portion of this money received to implement evidence-based practices to monitor and suppress coronavirus in accordance with public health guidelines, or conduct direct outreach to financial aid applicants about the opportunities to receive additional financial aid. That specifically is in the regulation. The question right now is how much is a portion, which unfortunately we do not know. And when that information will come out, I'm sure that will be disseminated to your institution. But as of right now, that's all we know for HEERF 3, but we wanted to make sure to clarify that as well. So Murray,
Great, thank you. Yeah, that's great. So what we're going to do now is try to, the folks have agreed graciously to stay on until 11:30 to try to answer some of these questions. So I'm going to try to go through them, read them, and maybe if some of our colleagues from the CPA firms might be willing to chime in, that would be great. So I'm going to just start at the top. Is the unpaid student balances only for students who have a need? And I think, well, maybe I can answer some of these. I think if they haven't paid the balance and they can't persist because of that, then I think they'd have a need. I don't know if guys, you want to comment if there's anything more.
I would agree, because it doesn't, you're supposed to target the neediest, but it doesn't say you can't target someone without need.
Got it. We received our institutional GAN HEERF 3 this past Tuesday. However, we've not received the student portion yet. Our budget period ends 1/18/22.
That was the first I've heard of that one, I would say. Yeah. I haven't heard of any other institution receive it yet. I mean, the allocation hasn't even come out yet from the Department of Education.
Right. Yeah. So when we received our monies, we've received the institutional and the student at the same time. I mean, they're different notifications, but they come at the same time. So I'm kind of confused. I think that's a one-off, maybe call the Department of Education for guidance.
Yeah, Marty, if I could quick, I think late,
yes.
Yeah, I think further down in the Q&A, I think that same person, it's obviously listed as anonymous, but I think they posted a clarification that it was an updated HEERF 2 notice that they got instead of the HEERF 3. Yep.
Okay, good. I think the Department of Ed is setting time limits that would be before 9/30/23 so that Ed can ensure funds are spent by that timeline. Schools still need to apply for the extension if they wish to push the spending past the GAN dates. Does that seem accurate? I don't know if anybody can add. I thought the deadline was 1 year after the HEERF 3 notification, but I guess it's 9/30/23. I think
well, they wanted to spend all the money by 9, because your notification could come out later. So I think that's probably the latest date, but you're right. I think once you get your notification, I think the clock starts.
Okay. When you allow your discharge of student balances for institutional funds, do you make any distinction about it being contingent of students continuing enrollment?
No. In fact, you're not permitted to do that, actually. So that can't be a condition for dismissing the balances. They specifically stated that.
Thank you. I assume using the institutional dollars to pay down accounts for students who stopped out cannot be contingent. Okay, we just talked about that. Two people on the same one, not I'm on. What about the outstanding balances prior to 3/14/2020? Students often owe for prior semesters when enrolling.
Marty, I think they're, oh, sorry. I guess my take
I was going to say that we're forgiving that under the premise that the person can't pay that prior balance because of the COVID implications that have happened since March 2020. Now, we're not going back prior to the fall term of 19, anything prior to that. But we're saying folks that were with us in the fall or winter who can't pay now, the reason they haven't paid is because of COVID impacts that have occurred after March 14th. So yeah, we're going prior to that, right or wrong. I don't know, Ryan, I'm sorry to interrupt.
I think I would agree. It all gets back to, is that balance prohibiting them from continuing their studies? And I think if that is indeed the case, that, and you're right. I mean, you don't want to go too far back, but within reason, as to, when that
Yeah, schools I've talked to are applying that logic as well, because once again, if the coronavirus didn't happen, they'd be maybe possibly to pay that balance. So it existed, that student's still there. I think most schools are going back and forgiving that.
The next one I have is, if you choose to apply institutional funds to unpaid student balances, do you still need to obtain student permission to apply the funds to their account?
If you use institution money, you do not. If you're using the student portion, you have to get the consent.
And Ray, if I'm not mistaken, though, if you do that, you have to at least communicate to them
Notify,
that you are
correct.
doing.
Yes, you do notify them, tell them, but you could do it and then notify them and tell them. Whereas the student portion, you actually have to get the permission up front. That's the big difference.
Can we claim lost revenue and lost state aid due to decreased enrollments?
Now, Marty, I know that this has been a question with state appropriations, and for the most part, yeah, if state appropriations were cut, that is considered lost revenue. But in Michigan, we've had an issue where they've turned around and given money back as care relief funds, or what we call replacement revenue. I see there's a question later about that someone said that they got some notification from DOE that was permissible, but my understanding was if you have replacement revenue and you're spending that same amount, even though it's unrestricted or other items, you can't claim that for double dipping.
Okay. There was another question about the student portion balance outstanding prior to March 2020. I think we answered that. On Lisa Faulkner's question now, how are universities posting the lost revenue on the grant fund to reconcile it to the draws made from the U.S. Department of Education? Will Ed expect these to be reflected on the CFA?
And my understanding is that they are expecting it to be reflected on the CFA. If you go to the question number 8 on the lost revenue FAQ, it refers to having the estimated lost revenues and expenditures on the CFA. I would anticipate we would have additional disclosures in the footnotes that talk to that lost revenue piece. And Ryan, I don't know if you have anything further.
I would agree.
I received communication from the DOE that lost state appropriations can be included as lost revenues. Okay, I think you kind of answered that, right?
Yeah, I haven't heard anything specifically, so that might be something for the institution to, again, maybe get more clarification from the DOE and make sure they understand the replacement revenue piece of it.
Since we can go back to prior to 12/27/20 for expenses, I assume we can go all the way back to spring of 2020. We provided room and board refunds in the spring. We claimed $500K from CARES for that. Safe to assume that we can claim up to another $3 million using CURSA and ARPA. So the difference, the delta between the room and board refunds and the lost revenue, I think that's fine, guys.
That would be
Yeah.
Yeah, as long as you're not double dipping and taking it 2 times. Yeah, correct.
Can you clarify fees related to debt service activities cannot be claimed? A portion of our student fees are used to pay debt service on the auxiliary facilities. Does that have to be excluded?
And I would think if it's included as kind of double dipping, that is a specific exclusion of lost revenue.
Makes sense. Is the marketing exclusion specific to marketing of our university? In other words, does it exclude company marketing such as a soft drink contract or a company advertising our baseball field wall?
I would think so. Go back to your disclaimer at the very first slide.
Yeah, so keep in mind, you should please ask your auditors for their opinions on these things. That, you know, what these guys say, they're not your auditor. Maybe they are, you don't know. So it really matters what your auditor thinks. CACUBO released an updated tutorial on HEERF 2 RevRec on their website yesterday related to the approach Marty is referring to now. Good. Okay. Thank you. That's helpful. Thank you, Peter, for that. Doris, the shares are not proportionate. A percentage seems more adequate. I'm not sure. Is that referring to my comment about using the institutional share as in the same percent? I meant percentage actually is what I meant to say. Is that, did I say it wrong?
Yeah, I can't recall exactly how it was stated, but I agree that the percentage would be the appropriate
Good.
Approach.
Good. Brenda, the CFA only shows federal expenses and there are no expenses that offset the lost revenue, so nothing would show up on the CFA, I don't believe. Please clarify how we should record lost revenue since we have no expenses to offset.
Yeah, I still think they're expecting it to be on the CFA, even though there's no direct expenses. They want to see what's charged to the grant, and that's considered a charge to the grant. And again, we'd probably have footnote disclosures to, just like you would if you had non-cash items, you would have to have some kind of disclosure.
Okay. My next question was from an anonymous attendee. I think it's about debt service. We talked about that already. The next one then was from Angela. Are you considering lost revenue as non-operating revenue?
For those under GASB, we are, as it falls under GASB 33. And then I think, Ryan, it's different for the private institutions under FASB.
Right. Yeah, the approach taken on the FASB side that I'm accustomed to is reflecting it as operating revenue. If you know, and it's up to institutions on that side too, whether or not they show a bifurcation. So.
Where is the guidance on the allowability of siloing to calculate lost revenue coming from? DOE hasn't said this, and many auditors don't believe this to be true. So I think that it's an interpretation, and I'll just chime in, I guess, guys. I think it's an interpretation of the rules. I don't think it's in black and white from the Department of Education guidelines, but they list all kinds of different types of things that you can claim as lost revenue, all the different types of aspects. And this is one way to calculate it. And I think, you know, you have to talk to your auditors to see if it complies. I'm not sure, guys.
I would agree. I think, and as I mentioned in my comments, a lot of it gets back to what approach best depicts the true impact of COVID on the institution, and based on the nature of the programs that fall into those colleges and those that are, you know, more likely to be impacted by, you know, the uncertainty going into the fall.
Got it. Do I understand that we should not draw down HEERF 2 institutional share until we spend HEERF 2 student share?
No, you can draw the HEERF 2 institutional share down as you spend it. It's just revenue recognition is going to be slightly different than the cash activity that you draw down.
Thank you. Do we have a 90 days from receiving GAN to start drawing down HEERF 2 funds?
I believe, yes, you do.
Correct, yeah.
We covered that one.
That's been the same for all of them. Once you get notification, you have to at least start drawing it down 90 days.
Mm-hmm.
Can you use institutional dollars to incentivize student completion at the end of the semester?
That certainly is a gray area, I would say. I don't think you can give, there's a flat answer we can give right now on this one right now.
Can you elaborate on DACA students in the institutional portion? I know it is not clear, but repeating it helps. We have minority serving funds too.
My understanding that they were looking at alternative funding for DACA students, but that it was not part of the HEERF funds for student grants.
Yeah, because what they went back on, of course, is, as I mentioned, we mentioned earlier, is the Personal Responsibility and Work Opportunity Reconciliation Act of '96, where it specifically excludes non-citizens, and DACA unfortunately falls into that. Now it still says there could be further guidance, you know, potentially down the road they could be allowed, but as of right now, if you really apply that act, they would be excluded.
Yeah, I believe on the recent CACUBO town hall, the messaging there was that they're awaiting clarification from the Department of Justice.
Okay, I'm going to skip down to Jill. Have other institutions received their 314A2 SIP funding yet? Our funding amount is available on the Ed website, but we haven't gotten any funding. I don't know if anybody can comment on that. I don't know. Okay. Anonymous attendee, it appears indirect costs are allowable on the institutional portion of the award. Can institutional indirect costs be calculated on lost revenue?
I know that's one that we've been asked the question on right now, and although it is a revenue stream in essence, or it is an expense based on how they're noting it in the FAQ. But we're recommending institutions to hold off on applying it to that as it stands right now, because it doesn't appear to make reasonable. It doesn't seem to be reasonable to apply it on that revenue stream right now, and we have some. And I know the Department of Education may come out with some more guidance on that, so we're recommending to hold off on that because we don't have an answer, unfortunately, right now.
Can you discuss the difference between the timing of the CEFA expenditure reporting and the timing for revenue recognition, given this might be different?
And that would be different. There's two parts to this. One, for the institutional portion, if you're not recognizing it all yet because you haven't recognized all your student portion, even though that's been incurred, and you're not recognizing the revenue recognition on financial statements, you would still recognize it on the CEFA and be subject to testing. And then there's those expenditures or lost revenue that you're picking up from prior period, because now you can go back to March 13th. Those will get picked up, even though they were recognized as the expenditures are recognized prior year. You're gonna pick up the expenditure on the CEFA this year. So there's going to be a little unusual looking activity comparing financial statements to your CEFA.
And I think we mentioned earlier too, really having notes to the CEFA is going to be very important this year, because you're going to tell that story a little bit better in the notes. And I think the department will want to see that anyway, and who's ever reading your single audit.
I said the next one I have is on a previous HEERF webinar, you included HVAC improvements. I'm not sure, that's still an appropriate eligible expense, right? I mean, is that what this is asking? That's the way I read it.
Yeah, I mean, what I've seen, and we got an answer back for one of our things. HVAC improvements, it depends on how you're going to classify it at your institution. If it's repair and maintenance, in essence, you don't need prior approval. But if your HVAC is improving the value of an asset, building improvements, you would need to get the approval, but that's irrelevant. It still is an allowable expense. That pre-approval aspect that I mentioned before, which I think is where this is coming from, is just a step in your procurement process that you would need to have. But the overall allowability of the expenses, yes, it would be allowable.
If you do a year-over-year comparison to calculate lost revenue for 21 and do not charge the HEERF grant until 22, which CEFA do you report it on? I think it'd be 22, right? I bet that's kind of a slippery slope, right?
I think it's when you charge the grant. So if you're not charging the grant until fiscal 22, then that's the CEFA it should go on.
Got it. So we would record the lost revenue as grant revenue and not record associated expenses. Correct?
Yes.
Yep. Can you confirm that funds have to be sent to students 15 days from the drawdown? Did that change from the original guidance of 90 days?
No, 90 days is when you should start drawing the money down. 15 days, once you have the money drawn down, 15 days to disperse to the students.
Got it. Are you required to reduce lost revenue by the amount of expenses that were reduced related to that revenue? For example, is lost dorm revenue required to be reduced by savings in food service and other utilities?
Yeah, I think we had talked about that earlier, that you should be looking at that net cost, because in a way, you're not incurring those expenses. So in a way, that's double dipping. So you should really consider, if you're not paying for food inventory, when you look at the money that you're losing for food plans, you need to kind of consider that as well.
Let me ask another question similar, and I think we talked about this earlier, just to make sure I'm on the same page. With respect to lost revenue, tuition revenue, you're not incurring any incremental adjunct expenses because you're not teaching as much. Do you need to reduce your lost revenue by the adjunct savings that you're enjoying, I guess you might say? I have not been. I'm not thinking we would be. Is that fair? Is your understanding?
Yeah, I guess my response to that would be probably, it depends. And from a practical perspective, I totally see what you're saying, Marty. how do you come up with what that true number is, or even a good estimate of it? So I think it's evaluated on a case-by-case basis, and most definitely one of those situations where schools should consult with their audit firm as to what makes the most sense based on their situation.
Yeah, Marty, I would just add to that. I mean, it's a business risk evaluation that the school has to do. I mean, the one thing you're supposed to continue paying employees and vendors, like they said in the agreement. So to the extent that you're not paying that, you would want to consider it when you're drawing down money, because you don't want to make the school better off than they would have been before the pandemic. So it's certainly something to consider. And we don't know what the reporting requirements are going to be, but they could look at FTEs. They could look at certain things to see what the comparability periods are, to see if revenue is appropriate, as the pandemic began, occurred, and continued on.
Could the institutional portion of the HEERF grant be comprised of both operating revenues and non-operating revenues? For example, if the funds are being used to cover COVID safety supplies, would that be considered operating revenue expense as compared to lost revenue, which would be non-operating revenues?
Well, for GASB, it would still fall under non-operating, because under GASB 33, we're saying it's a non-exchange revenue. And then that's the reporting that it would fall under. And then, Ryan, I don't know, from a FASB world.
Let's see here. Sorry, I had something else pop up here, and I was trying to dig into another question. But could you just repeat that question real quick? Which one was it?
They're asking if you can split it between operating and non-operating revenue.
I'm trying to imagine a situation on the private institution side where you'd have an element that's non-operating. Typically, the revenue sources that go in there are for things that are for long-term purposes. I mean, if there is perhaps a capital asset that was being acquired with those funds, there could be an argument for that. So.
We know the actual amount paid out for room and board in 2020. Are we able to take that dollar amount less the HEERF $1 recovered? And then for other revenue, can we use one of the other options, or must all the calculations be done the same way? I think we indicated that if you're using one method for room and board, you have to use that method consistently. You can use a different method for a different workshops or something like that. Is that fair, Bill? Everyone?
Yes.
Yes.
Okay. This is Sally. For lost revenue, do you need to take into consideration the expenses that did not occur? I think we just talked about that. So there's,
yes.
Yeah, you're telling us, like in my case, I need to take out the adjunct cost. It would be good if I did that. I'm continuing to employ all my faculty, my full-time faculty, but adjunct cost is going down because I don't have as many classes. I should take a reduction for that, is what you're thinking.
Yes.
Okay.
Again, so that you're not putting yourself in a better position than you were before, but that's something that you did incur.
Okay.
Well, what I'm hearing too, though, sometimes is as classroom reconfiguration occurs, you could have an opportunity to actually have more adjunct because you have to reduce class sizes in some cases. So I've heard about that as well. So understanding what you're doing with your classrooms in the next period is also important.
Okay, this person just received clarification that it was an updated GAN for the HEERF 2 funds. Okay, that she clarified her question, sorry. Would the lost conference revenue be gross revenue or net profit?
Well, this goes back to, you probably didn't incur the cost in having that conference event. So again, you're looking at it in a net perspective, not the gross. Okay.
Can you clarify when calculating LRS revenue, do we need to offset it by average scholarships? I think the answer is yes. Okay. Ryan asks, another Ryan, net received from students. The FAQ issued by DOE in question 8 indicates that an institution does not need to subtract replacement revenue the institution received in calculating its amount of lost revenue. Can you explain how that should be applied?
So so this is being driven by the comment on the net, using the net tuition per student. So that's reflective of what the school would anticipate would actually come in as an inflow of cash. Here, the reference to question 8 does not need to replace revenue. So I think this is getting to, if there's a new source of other revenue that's that particular question, I think maybe ties into example that Jenny gave earlier, that some institutions maybe lost a certain portion of revenue, but it was replaced by something else. I don't know, Jenny, do you have thoughts on this particular question?
Yeah, so yeah, to me, there's a distinction between, we were talking about netting expenses that you're not incurring or saving on, and this is different, and we're talking about replacement revenue. So it does state that in question 8 that you don't need to take into consideration subtract out replacement revenue, but I'm not sure how that necessarily plays out in the calculations of lost revenue.
We've had a couple institutions look at that, like if they're looking at their revenue from like an online program versus a campus program. So if they're looking at the campus program, it's obviously going to have gone down, or something of the similar, but another program may have increased related to the pandemic, that you would look at those independently, but then consider at the whole, is this reasonable and appropriate for the institution at the high level?
Yeah, I think part of that comes back to, you know, kind of analyzing the facts and circumstances for the institution. I mean, I suppose if an institution just, you know, had a situation where it was more of their full pay students that were not coming back, or that were not coming on board, if it was their first year, you know, international students, whatever it might be. I mean, there could be an argument certainly for using something higher than the average net tuition per student.
Got it. I think we're at time at 11:30, and I would be respectful of our panelists who've been so gracious to volunteer to help us with this today. We'll try to capture the remaining questions and see if we can send out some notes with some thoughts on some of these after the meeting. But I just want to send a big thank you out to our panelists and our CACUBO members here for joining us today and helping us with this meaty topic. I know we're all struggling with this. I think that the best advice we can give you at the end of the day is to document, 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 and to consult with your own auditors about their thoughts on your different methods and parameters and thoughts on this. And I don't know if anyone has anything else to add. Otherwise, thank you all for attending, and we'll continue to have these webinars. And just another plug for our Accounting and Business Operations Workshop next month, and the reserve on your calendar September 27th to 29th for our annual meeting, which will be held virtually this year. Thank you again.
Thanks.
Thank you.
Take care.